Most buyers and sellers are initially so focused on the purchase price, or sometimes the terms. But in reality, many deals go sideways just before the closing table over a third factor that nobody really thinks about until it's almost too late: working capital. If you don't understand it before you sign your LOI, things can go bad. Today, I'm going to give you what it is, how it gets negotiated, and the one question to ask a seller before you even make that offer. Welcome to Business Buying for Financial Independence. I'm Tim Delaney, and I help young professionals buy small businesses so they can escape the 9-to-5 and take control of their time, income, and future. If that sounds like you, hit the subscribe button and let's get into it. So, what is working capital? Very basically, your working capital is your current assets minus your current liabilities. Current assets are generally your cash, your accounts receivable, and any inventory that is immediately ready for sale, while your current liabilities are things that you need to be paying within the next 30 days or so. Things like vendor bills, credit card bills, and things of that nature. So when you think about working capital, you need to have enough cash in the bank to cover everything that you need to be paying in the next short-term period. This is vital to any business. If you run out of capital, if you run out of working capital, your business cannot sustain. That's when business owners start resorting to things like merchant cash advances and other predatory loans that end up putting them even further behind. So it's very important that you have good working capital in any business, but especially when you're going to buy a business. If you buy a business and you don't have enough working capital right from the start, you can easily be out of business in just weeks. If your vendors and your suppliers are demanding payment on things and you don't have cash in the bank and your customers aren't paying you yet, you're going to have a problem. The vendors will cut you off, you won't have new product to ship to future customers, and all of a sudden, your whole system dries up and disappears. Now, every business is a little bit different. So for example, when I bought the wine and liquor store, I actually was in a very good position working capital-wise. Besides the fact that I did have extra working capital in the bank from day one, with a business like a wine and liquor store, I had 30-day terms with my vendors. So I didn't need to pay my vendors for 30 days. However, my customers were paying me the day that they bought their product. Sure, some was cash, some was credit card, so maybe 2 or 3 days later I would get that money in my bank from the credit cards. But essentially, I'm getting cash immediately. When I first bought the store, I had 30 days to pay for all the new inventory that I was continuing to order. I was ordering inventory for the next day because customers keep buying stuff. So I was in a fortunate position. But some businesses are the opposite, where they might take over a new business and they might not have any money coming in for 30 days, but they've got to pay bills immediately. Those in particular are the businesses that really need to pay attention to working capital and make sure they have enough of it when they close on the deal. The size of the acquisition also plays into how the working capital is going to work. In larger acquisitions, the seller tends to leave working capital in the bank for the buyer. This is called the PEG. It's how much working capital will remain with the business during the sale. Now, when it gets close to closing time, they take a look at what that PEG was, and if there's more cash than is needed, the seller can take some at closing, or the price of the business just goes up. If there's less cash, the price of the business is going to be lower so that the buyer has some of the extra cash that they're getting from financing to put in the bank account to make sure that they can cover their expenses. So establishing that PEG early on in the transaction is important. This is going to be a big negotiation point during that initial LOI phase because the seller is obviously going to want it to be less because they want more money out of their accounts, and the buyer is going to want it to be higher so that they have a sense of security and safety when they buy the business to make sure that they're accounting for any unforeseen issues with working capital. It's very important that you get that number right as a buyer. You're going to want to look at the past 12 months of cash flow and take a look at what those current assets are minus the current liabilities on a month-by-month basis and take some kind of average. But you also have to be careful of the seasonality of businesses. For example, buying a wine and liquor store in November versus January is a whole different world of how much cash is coming in and how much cash is going out. In January, I have way less cash coming in, but I have a lot of vendor bills that are due from December ordering when we were selling a lot more stuff. So if I had closed on that store in January, even though I just talked about the fact that I had a nice runway, it still could have been a struggle because that cash is so significantly less in January, and those vendor bills are still coming in. So you want to be careful. You want to take some kind of average of the last 12 months, but you also want to pay attention to the industry you're in and the seasonality and how the closing date is going to affect your cash needs for that business, for that working capital. And this is more relevant, like I said, in larger transactions, because what usually happens is all of the accounts receivable, all of the orders that a company has shipped to customers and customers still have yet to pay, and all the accounts payable, the things that the business has spent money on but hasn't actually paid the bill yet for, those accounts receivable and accounts payable usually stay with the business in a large transaction. Now, in smaller transactions, a lot of times the accounts receivable and the accounts payable are going to stay with the seller. So this is a little bit less of an issue for a buyer of a business in that sub $2 million, $1 million range, because usually the seller just takes those accounts receivable and accounts payable going forward. At closing, they'll write the checks to the vendors and anybody else out of their proceeds to get rid of their payables. And if there's any outstanding invoices, those customers are still sending the checks to the old entity or the seller, and the seller gets those. Usually those smaller transactions especially are going to be asset purchases instead of stock purchases. So those checks from the customers are still going to be made out to the old entity. So it's just a cleaner way of doing business when you're buying a smaller business. Now, that doesn't mean if you're buying a small business that working capital still isn't important. Just because you're not getting all the accounts receivable and the accounts payable doesn't mean you're still not going to need working capital. In fact, there are some banks that will require you to bring extra cash to the table at closing to make sure that you have enough working capital. And like I said, even depending on the time of year or depending on what type of business it is, even if the seller is taking all those AR and APs off your plate, you still might need some runway depending on how the billing and how your customer invoicing and how your vendor billing works. You might be invoicing your customers on a 30-day basis, and your vendors might be invoicing you on a 15-day basis. So you have to make up that difference with some extra working capital. So just make sure you're paying attention to that. It doesn't just disappear because the seller is taking up on those things. You also don't know what unforeseen circumstances can happen in those early days of the business. Maybe you lose a customer. Maybe a customer runs into trouble and starts paying late. Maybe a vendor offers an amazing deal on something that you really want to be able to capitalize on. With some extra working capital, that can be possible. Now, like I said, this is something that can be negotiated. Even on a smaller deal, you can negotiate leaving the accounts receivable in but taking the accounts payable, or leaving some cash in the deal so that you do have working capital from that perspective. It's not super common in those smaller deals, but on the larger deals, it is. And it's important, like I said, that you get that number right and that it's factored in. We had Mike Webster on episode 28 of Business Buying for Financial Independence, where he talked about the fact that the seller had been taking cash out of the business leading up to closing, and all of a sudden there was a massive shortage right before closing. So Mike had to lower the purchase price of the business to be able to make sure that he had enough working capital going forward to start out. He's in the construction business. There can be a lot of delays in getting paid, but he's still got to pay his employees and pay his vendors and all that kind of thing. So he dropped the purchase price by the same amount of cash that the seller had taken out. So at the end of the day, it was no real major hurdle for him, But the banks could have caused an issue. The bank could have pulled back or gotten nervous or thought that something had happened that caused the cash to disappear. Luckily, the seller was able to show where that cash went and that it wasn't like an emergency of the business and the business wasn't suffering. So the purchase price got reduced by the amount of cash that he took out. I also talked to another buyer recently, Ryan, who was kind of surprised. His situation is a little bit different, but leading up to closing, he had gone through all the approvals. He had gotten approved for the loan. He had his cash 10% down that he was planning on putting in. He had a seller's note. And then right before closing, the bank said, oh, and don't forget, you need to bring double your down payment because we want to see you deposit that cash in the bank as cash so that you have working capital. Now, Ryan thought that his numbers were good. He didn't, thought he was covered, but the bank didn't care. They wanted to see him pull cash out of his retirement accounts and deposit it into the bank account at closing so that they were comfortable that he had enough working capital. It didn't matter that he had that access to that cash if he needed it. They actually forced his hand. He had to pay taxes and penalties for pulling that stuff out in the way that he did. Luckily, he had access to that because that could have been another whole hurdle had he not had some of that money in retirement accounts and enough to cover what the bank was demanding. So think about working capital early in the process. Think about how it looks. And this is something that I generally do when I'm evaluating a purchase, is looking at things on a month-to-month basis. It's easy just to kind of glance at numbers on an annual basis, but you forget that every business, most businesses, have some level of seasonality to them, and some seasons or months are going to be up or down, and sometimes you need extra working capital at certain times of the year to get through those periods. And so if you're closing right before or right during one of those periods, you might need more working capital than you think if you only did a total year analysis. Now, the working capital will vary depending on the industry you're in. Service businesses, it's going to be a little bit lower unless you're using a lot of subcontractors who need to get paid quickly, but usually in the 5 to 10% range for service businesses. Retail, especially heavy inventory retail, could be 15 to 25%. And retail is an interesting one. Like I mentioned with my wine and liquor store, I was in the fortunate position of having those 30-day terms with vendors right off the bat because it's kind of the way the laws are structured in New York State. In certain retail, that cycle can be a lot shorter with vendors. It could be 14 days, could be 7 days. Or the vendor might see you, even though the business has been established, the vendor might push you to pay on delivery to get started because you're a new person, new entity, and they don't trust you yet. So even if the business has history, and you should be able to push back on the vendor in those situations and try to get them to push it out, but you might run into that as well. So just be aware that with retail, not every retail is like wine and liquor where the terms might be just kind of standard for the industry. Distribution and wholesale might be 15 to 25%, and manufacturing could be 20% or more. Just really depends on the lead times from vendors and what kind of customers you have and how quickly you're able to invoice them and how quickly they pay. So the one question to really make sure that you get out of a seller early on in the process, especially for these larger transactions, is what's the working capital target that you're delivering at close and how did they calculate it? You want to make sure you focus in on that number and figure out how they came to that conclusion and whether or not it makes sense for you and whether or not it's going to give you that security and comfort that you need, and also the security and comfort that the bank is going to need. And make sure you're talking to the bank early on in the process about this as well, especially if you're doing an asset purchase and you're not necessarily thinking about the seller leaving working capital in the business. Make sure your bases are covered right from the beginning. Don't get caught off guard at closing or close to closing and be scrambling around to figure out how you're going to come up with the working capital to move forward. Hope this has been helpful. If it has, please drop a comment, shoot me a message, and let me know what you think. Or if you've run into a working capital issue in an acquisition, I would love to hear about that and maybe get you on the podcast in the future. If you have a moment, please leave us a rating and review. It really helps other people find us. Would really appreciate it. And I'll see you all again soon. Cheers. This buying for financial independence. If you're serious about owning your time and building long-term wealth, make sure to subscribe so you don't miss the next episode.